Alpha Institutes hosted its CIO Summit last week. It's a conference that brings together allocators, decision makers who are focused on alternative investments. Alan Zafran was there. He is the co-founder of Luminous Capital. He has about 300 families' assets under management. It ends up totaling around $4.6 billion. I asked him where he is finding the most opportunity, the highest yields.
First of all, I would argue conventional treasury bonds don't have a lot of value. You could look at high-quality municipal bonds and squeeze out 2.5%. You won't make a lot, you won't get hurt. That's a nice ballast to an aggressive portfolio. Where we think there's more value is in the residential mortgage-backed securities industry. Those are sophisticated securities to buy, but there are a handful of managers who have real skill. They do deep diligence to understand the kinds of bonds they're buying. And therefore, we think the yields on those bonds are anywhere from 6 to 12% have real meaningful value. So I would argue RMBS in conjunction with investment-grade bonds makes sense. The other area I would highlight is high-yield bonds, but they have to be bought at the right price. There's a large correlation between high-yield bonds and equities. And because we've had such a volatile market, our belief is you should be looking to buy high-yield bonds on weakness. Right now, they're not quite cheap enough because of the potential for defaults and low recovery rates. But if we saw a sell-off something close to what we saw 2 months ago, we would be aggressively looking towards high-yield bonds.
So very specialized residential mortgage-backed securities, and again, very specialized. If you have done your homework, high-yield debt still looks good.
That's correct.
You also said distressed assets as a larger umbrella is something that you've been able to fish around, and some of these products included, I'm sure.
Yeah, that's right. There's a couple variations on that. One is we've structured a fund called a sell net leaseback strategy, which is a pretty interesting strategy. You take a business that's reasonably strong in its cash flows. The problem is it has a debt coming due soon. It doesn't have enough to pay cash to pay off the debt. It can't get refinanced under conventional banking measures. So what we will do is go in, buy the building, release the building to the tenant. They enter into a 20-year triple net lease. We enter into the rent with a inflation adjustment, and we own the real estate as collateral. That has buildings can yield upwards of 8 to 12% under that structure. Another structure which also might make sense is distressed assets. There are certain loans to commercial or small businessmen where they failed to pay because banks haven't been bothering with small loans, chasing after the borrowers. They don't have enough time to do so. So there are a handful of firms that have 4 things that make them skillful. They have the ability to analyze complicated pools of loans. They have the capital to buy the loans from banks or other distressed sellers like insurance companies or hedge funds. They have the relationship to get the phone call because these are privately negotiated transactions. But most importantly, they have the servicing capability that once they buy the asset, where the value is added by going after the borrowers and restructuring the loans from what was non-performing to something that's performing, maybe not at par, maybe only at half of par. But if you're buying the non-performing loan at 15 to 20 cents on the dollar, you're actually squeezing out what ultimately is a high-yielding asset based on your purchase price with some appreciation potential.
So there clearly are opportunities out there. What about some of the alt opportunities? We were chatting earlier. I was telling you about people that I know who are buying land rights because they want the water source, or buying farmland. And you said you've actually seen increased demand for these kinds of assets from your clients.
Yeah, what we're finding is people really want out-of-the-box solutions. The challenge is many of these strategies are emerging. It's difficult to find managers that have any kind of track record, dedicated management teams, and so it's a lot of on-the-come investing. We find it challenging to do so, but we've seen as examples people that advance money in advance of disability claims. They know the money is coming. The person who's disabled doesn't have enough income, doesn't have the money to live on. They, along with their lawyer who works on a contingency fee, is happy to take an advancement, and in turn you get back the money plus interest rates that run from 1.5% to 3% a month. So we're seeing some interesting structures, but again, the challenge is most of the structures haven't been proven, and many of the structures can't attract too much institutional capital because oftentimes they're very small in dollar amounts. So you have to be very selective, even more so than in conventional hedge funds, if you're going to pursue these non-traditional alternatives.
That was Alan Zafran, the co-founder of Luminous Capital.